This is a 5-minute update. This is a 5-minute update for March 5th, 2009. The stock market has become a day trader's paradise as values jump for one day and decline the next. The roller coaster ride continued Thursday as the Dow Jones Industrial Average shot down another 281 points. Citigroup was the New York Stock Exchange's most active stock, and it dropped another 11 cents to $1.02 per share. The economic crisis has turned some of the most prominent banks and insurance companies into penny stocks. Most economists agree that it is far from over, and the derivative Death Star is plunging straight into Wall Street. GE Capital drove General Electric shares down to the frightening number of $6.66. That's 666. So what should an investor do? Some might say invest in gold. Although inflation may affect the price of gold, it is tightly tied to the value of the dollar in relation to other currencies. If the dollar goes down, gold usually goes up. If the other currencies, including the yen and the euro, go down, so goes gold. Many investors feared rampant inflation during the 1970s and into the early 80s, when gold shot up to $750 per ounce. But then prices fell to about $300 for nearly 20 years, until it began to rise again after September 11, 2001. What if you had bought in the late 1970s? You would have had to wait 20 years to see a rebound. According to the U.S. Geological Survey, production of gold has been on the decline since 2000, if that helps you. The good news for gold investors is that the yen has been doing pretty good. In fact, Toyota says that the high value of the yen has caused their profits to drop. Japanese products have become less competitive as the dollar falls and the yen rises. Speaking of Japan, the Japanese stock market has dropped to a 25-year low. That is pretty startling when you consider the lost decade the Japanese experienced during the 1990s. The Nikkei 225 began declining in 1989 and did not begin to recover until 2003, but then slid again during the global recession. So when will the bull market return? Since 2007, $10 trillion of stock market wealth has vanished. The Dow is down 53% since October 2007, with the financial sectors doing much worse. Bear markets usually last about 15 months, so we should have been out of this decline already. The only other relevant bear market you can look back to was the Great Depression. Similar to today's Dow, investors were on a roller coaster ride with the overall value of the Dow dropping over a 3-year period until 1933. The scary news is that the Dow did not recover to its 1929 levels until the mid-1950s. It was a very slow process to reach its 1929 price. Using the Great Depression as a model, it could take 20 years or more for the values of the stock market to recover to 2007 levels. This has been a 5-minute update. Remember to subscribe to our videos. Remember to subscribe to our YouTube channel.